Welcome to the Legacy Lounge, Jay. We're so glad that you're here.
Thanks for having me, Deb.
Now, you're here as co-founder of Life Insurance Strategies Group, and it's interesting. You guys are a fee-based consulting group, and you don't sell any life insurance products. Is that right?
That's right. That's right. So we're not licensed to sell life insurance. We don't sell life insurance. And generally, our team is engaged by affluent families or companies to help them make a decision where there's some type of complex situation involving life insurance. So that might be, should we even buy life insurance? And if we did, what would the structure look like? We even take the role of helping them vet and find a broker and negotiate fees. So really sitting on their side of the table in the transaction.
Great. So how do you actually engage initially, right up front, with your clients, and what's your process?
Yeah, so usually we're reached out to through a family office or a law firm. If it's a company, maybe through their chief financial officer or chief operating officer, where they say, we've been thinking we might need life insurance, we're not sure. And so by working with our firm, they don't feel like they're being sold life insurance, particularly if it isn't necessary. So we'll kind of lay out sort of our plan to investigate their need for life insurance. And then if they do decide to go forward, we'll run that transaction for them. So again, it might be vetting a producer, supervising the installation and sale of products, how the ownership structure might be set up, and even how the beneficiaries might be labeled.
It sounds like a conflict-free, unbiased, and pretty pragmatic approach to life insurance.
That's it exactly. So our fee only comes from the clients. We're not being compensated by life insurance companies or by the sale or commission anything. We work just like a law firm or an accounting firm. And again, if there's no life insurance sale to be made, we're happy to say, this isn't for you, and move along.
Maybe it doesn't fit.
Maybe it doesn't.
Very helpful. I have to tell you that the market study that you co-authored is kind of become the Bible, I think, for a lot of advisors. And today, although you consult on a lot of solutions, we're going to focus on private placement life insurance. Yeah. And I know Life Insurance Strategies Group has done a lot of work here, and you've become somewhat of a globetrotter, helping people design these cases. So what is this thing that seems to be, I guess if there's one topic in wealth management that's trending, it might be private placement life insurance. So what is this thing called PPLI?
Well, that's right. So there is a lot of talk about private placement life insurance. So we'll keep calling it PPLI from here on out, but I want everyone to know it stands for private placement life insurance, which in itself is a little bit of a misleading. So it's definitely life insurance, but it's more of an investment transaction or an investment strategy than it is a life insurance strategy. So what you're doing in private placement life insurance is you're taking the benefits of life insurance and applying them to highly tax inefficient investments. And so, let me kind of back up there. And I think a lot of people would be more familiar with say, traditional life insurance, where maybe they buy a Northwestern Mutual policy. And so what they do there is they give their premium, their money to Northwestern Mutual, and Northwestern Mutual says, hey, we'll take it from here. We'll invest this money, we'll apply a share of that return to your policy, we'll credit that, and if you die, we'll provide the death benefit. So we're going to make all decisions about the policy. Private placement is sort of at the other end of the spectrum, where an affluent individual says, well, wait a minute, I have my own investment manager, I have my own custodian, I'd rather that my own investment manager made investment decisions about what's underlying my insurance policy. So I'm just going to take the insurance structure from the life insurance company. I'm not going to take all the other sort of offerings that they have as far as investment management, custodian services. So that's sort of the main idea behind PPLI.
And the key features that attract people, especially tax attributes. Can you speak to the benefits that PPLI provides?
Yeah, so PPLI is definitely a long-term strategy. So again, I always have to remind people, especially because they start to look at it as more of an investment transaction, which it is. It is life insurance. And so with that respect, you need to sort of stick with it for a long period of time to see the benefits. And so the benefits really are the same benefits that you have with a retail policy, but maybe applied to different types of asset classes. So those benefits are the ability to invest money and have it grow tax-free inside of the policy. The ability to perhaps take money out of the policy in the form of tax-free loans or withdrawals later on down the road. And then perhaps the biggest benefit, and the one that we see most families use it for, is the ability to turn what would be taxable investments into non-taxable investments, and then pass those investments in the form of an income tax-free death benefit at the death of the insured. So again, you're passing that wealth to the next generation tax-free.
So it's the compounding of all of that tax-free growth. And then if you add design techniques such as generation skipping trusts,
That's right.
You're looking at estate tax benefits as well, right?
Absolutely. And people will design PPLI to do different things, maybe to provide income in the future. But I'll tell you, in 21 years of working in the PPLI industry, I've seen probably less than 10 policies ever touched for distributions. So that tells me that the people that are buying them really are just keeping them in place until the insured passes away, and then passing all of that, all the investment proceeds in the policy to the next generation. So to your point, obviously these are mostly all trust owned, because you wouldn't want to have a large amount of life insurance in your estate. You want it out of your estate. And then not only do we see generation skipping trusts, Deb, we also see the use of intergenerational split dollar. So that's where maybe a grandparent loans money to a trust, above their exemption. That trust buys policies on generation 2, so the adult children. And then when those adult children pass away, those policies pay out to the trust to benefit grandchildren and great-grandchildren. So what you're doing is taking wealth you have today and really making it tax-free for 40, 50, 60 years and passing it on.
Yeah, it's really exciting, isn't it? And I think you made the point that it's really a long-term play. And I read you described it somewhat more like some of the corporate benefits, because when you're doing multi-generational planning, you might not only be insuring one person or a joint and survivor couple. You might be looking at the family dynamics, age, health, ability to pay, and all those things, and designing it, right?
So this is probably an exciting use of PPLI I don't think people fully appreciate. But family offices, law firms that are working with families that have a lot of members have kind of figured out. And so I like your example of the corporate use of life insurance, because a large company might buy a lot of policies on their employees. And by doing that, they say, okay, if I've bought 20 policies, actuarially, I know when someone might pass away. I know when that death benefit is going to be paid, and I can prepare to use those funds for other means. Well, think about it from an individual or a private family perspective. Let's say you have a family with 10, 15 members in G2. So a family office might be planning for all these family members. You could take wealth that is earmarked for generational transfer and then begin to buy life insurance policies, PPLI, on different members of the family, depending on their age, health, gender, and sort of spreadsheet out where you're going to apply that money. And then as these individuals age, all that money is growing income tax free. And then when they pass away, all that money is then transferred back to the trust income tax free, and you can write policies on the next generation. So it really is looking at this not as an emotional sale at all, but really as a pen to paper, a math kind of situation.
I mean, it's really simply diversifying your risk and increasing the opportunity that you may see more multi-generational wealth. And I think that's very exciting.
Well, and Deb, I tell people, so this is really for highly tax inefficient investments. And so there's some investments you make in your taxable account, bonds and lower interest earning types of investments. But for things maybe like alternatives, hedge funds, real estate, some equities, making those investments under a life insurance structure where you're going to make them the most tax efficient is the way to go. So you're absolutely right with the diversification point. That's how anyone using PPLI should say, okay, this is part of my portfolio, not all of it, but it's really where I'm going to do my highly tax inefficient investing.
And there are different investment structures, and we'll talk about that in a minute. But I think the interesting thing is that traditional policies clearly haven't had the kind of flexibility in investments. And I'm hard pressed to find out what you can't invest in PPLI now.
Well, okay, so I will caution you there. So I actually, and I think that's sort of the danger in PPLI is people get different impressions. Oh, can I put my artwork in there, or my horses, or things? And really, there are a couple rules, and I know we're going to talk about them. But one is the idea of investor control.
Absolutely, yeah.
So,
and I was thinking more of public and private investments. But yeah, I think that the idea of artwork and things like that go outside the the arc.
Or their boats, or their private company businesses, their private interests in their private companies. So I will say, let me give a shout out to sort of retail variable products for a minute.
Okay.
Because
where basically in the retail products, the investment is predetermined.
That's right.
There's a predetermined set of investments.
Carrier will have a platform of investments the person can choose from, sort of like a 401k. And there was sort of a first round of variable products in the late 90s that came out, but unfortunately there was a recession, and sort of, people who bought policies in 97, 98, when it was first a big thing, had huge losses. And so variable products kind of fell to the wayside. Well, today we're seeing a new generation of variable products issued by life insurance companies, and they're very price competitive, and their platforms have sometimes over 100 choices. So I do tell some people who are thinking about PPLI, first, if you absolutely need your own investment manager and there's some bespoke investments that you want that aren't on a retail platform for variable products, then let's talk about PPLI. But it may be that you can just buy a retail product and use that for accumulation and wealth transfer.
I think that's a change in mindset for a lot of people that are used to traditional insurance, because when I've looked at some of the carriers, things like private credit, which have been so popular over the last couple of years, names they would recognize are available inside those products. And so it's really a different mindset in terms of how you can invest, even in the preset. But as we both know, there are other ways. You talked about enlisting your advisor, and we can talk about that in a minute. But I did want to touch on the fact that when you're looking at PPLI, you are clearly focusing more on accumulation than death benefit. And there were some changes in 2021 that made that more attractive. Can you speak to that?
Right, that's absolutely right. So with private placement life insurance, in order for it to meet the definition of life insurance, in the early years, the contracts have a high amount of death benefit. And then after you've satisfied the government's definition of life insurance, that can take anywhere from 4 to 10 years, depending again on the person's health, gender, age. At that point, you get to lop off a lot of the death benefit, which is a lot of the expense in the product. And it's at that point that the accumulation benefit really takes off. So going back to, I think, our earlier conversation, you really need to be in these contracts the long term, 15 years, 20 years. This isn't something you can do tomorrow and expect a benefit a year from now. So with accumulation, prior to 2021, PPLI in a lot of situations made sense. So when people did the math, it had a nice benefit, but PPLI can be a little complex to put into place. So people said, I'm just going to skip it. Well, we had a tax law change at the end of 2021. And in it, the U.S. government changed the definition of life insurance. And it did it because we were in a low interest rate environment. It was getting very hard for some of the general account products like whole life, universal life to be able to fund to a person's age 100. And so the government came in and said, okay, we're going to change the formula we use to calculate if something meets the definition of life insurance. And they came back, they changed the formula, and it had a side effect for accumulation products. So whether it's variable universal life, the retail product we talked about, or it's PPLI, in some cases you can put 2 to 3 times as much premium or money into a PPLI or even a retail variable product for the same amount of death benefit. So what you've done there is now you've supercharged these products. So before, I put in $1 and I had to buy $2 of death benefit and pay for that $2 of death benefit, now I can maybe put in $1.50 or more, for that same amount of death benefit.
That's really clarifying, Jay, because I think that, mortality is the drain on performance, mortality costs. And so
That's right.
This really enables accumulation to take a front seat in the later years. Yeah, so really great.
And it's kind of mind-blowing. I think sort of in the market report that I co-authored, we showed, I want to say, we use an example of like a 50-year-old female, I think funding maybe $20 million, and she was able in the Prudential policy to increase by 80% the amount of money she could put in the contract. I think the study showed for Crown Global, which is a big PPLI carrier group, that you had somewhere between 80 and 90% more premium or money you could put into their contracts after this tax law change.
And that really, I think, it caused an acceleration in interest, because it certainly was not, it's just life insurance. It
Yes.
had that strong investment component that attracted people. That's really great. Though the idea of tax-free growth and the compounding and income and estate tax benefits are great, these policies are not a set it and forget it. They're not one and done. And there are two kind of Goliath rules with respect to maintaining the structural integrity of these. And I'm hoping that you can simplify this for some of us. I'm talking about the diversification requirement.
Sure.
And the investor control doctrine. So in whatever order you want to take those
How about
in.
we start with, I think we kind of overlooked sort of maybe the third rule, or the first one was about who can buy PPLI.
Great.
Right? So
Okay.
you have,
Yes. Who is it designed for? Who qualifies for it? Thank you.
The first kind of
That's the
guardrail
first, right.
is the government sort of says, look, you need to be a qualified purchaser or an accredited investor to buy private placement life insurance. So not everyone who can buy the retail variable products that we spoke about can buy PPLI. And the reasons for that is with PPLI, or one of the reasons, there's no guarantees in private placement life insurance. Somebody brings their own manager who, might invest in, say, alternatives, hedge funds. And if you get negative returns, there's no guarantees you can buy, like in the retail products. There's those types of guardrails and things that might be available to everyone who can buy life insurance products
And that's
aren't there.
a good point, because if you're looking to maximize death benefit and want guarantees, then traditional variable policies are probably preferred in that case. But PPLI can serve families that have taxes for generations to come, ergo the appeal.
And that's right. And so some people say, is it, is this just something for the wealthy? And I say, well, PPLI to some extent can be its own sort of punishment, because there aren't these guardrails. People could have huge losses just like they could have huge gains. Now, obviously, with professional money management, we hope not to see, losses with private placement, but that possibility exists. Mm-hmm. So let's talk about these rules that we have.
Great.
Right, the
Thank
diversification. You. So diversification, probably the easier of the things to address, and not too much of a problem. But the idea with diversification is, in private placement life insurance, you just can't invest in one investment. There has to be a diversification of investments, and the IRS and the Internal Revenue Code, and I think I can do this off the top of my head, is Section 817H5 actually lays out the thresholds for diversification in these products. Because what they don't want is somebody going out and saying, I just want Amazon. I'm going to put Amazon in here today, and that's it. They want this professionally managed. So they say no more than 55% of the asset value of the contract can be in one investment, and no two more than 70, no three more than 80, no four more than 90. And this is tested every quarter in the policy. And you have 30 days to cure that if through trading and buying and selling investments you get out of whack of that diversification. You have 30 days to cure it. And if you don't, then you've lost the benefits of PPLI. They say this no longer qualifies.
That's
so
the
huge.
red alarm bell that
Yep.
sounds off everything. So to maintain the tax-free structure, you really need to manage to this diversification rule. It's really tantamount to just rebalancing, but at the same time, the stakes for missing it are much bigger than they are otherwise, right?
Absolutely. And there are some things that the industry's done to make that a little easier. So there are two kind of structures you can invest in under private placement. So the first is a separately managed account, just like you might have at Morgan Stanley or your manager. In that separately managed account, you have an independent investment advisor, and he's selecting a direct investment. So he's making investments directly, just like he would again into your taxable account, but under a policy. And so he's making sure, that manager, that everything is diversified. Now, most of the time, you're not going to have a separately managed account that doesn't have dozens of different positions in it. So generally, with a decent money manager, you're not going to run afoul of diversification. The second item that you can have under a policy is called an insurance dedicated fund. And so this is an insurance version of a popular fund. So, a good example is Golub is a big hedge fund that's known in private credit. So under a managed account, your manager could invest directly into Golub's private credit under your policy. But Golub also has an insurance version of their private credit. We'll just call it, off the top of my head, Golub Insurance Private Credit Fund. Inside that fund, it's diversified. So there's at least 5 different positions in the fund, in that insurance dedicated fund. So it meets diversification just by itself, just by being an insurance dedicated fund. So what that means is, if I'm someone that has $10 million to put into PPLI, I can either go to my manager and say, hey, invest this however you want into a separately managed account. And we're going to talk about investor control in a minute. Or I could tell the manager, put it all into one strategy. And he can do that if it goes into one of these insurance dedicated funds.
And we say structurally you can do the same thing as you could in your own taxable investment account, but in fact there do need to be some differences. You can't have the identical
that's right.
taxable account
For sure.
and then the same investment in there. But there are service firms, administrators, that are there to assist advisors if the diversification rules and so forth become too cumbersome. There are companies that will help administer, right?
Well, exactly. So that's where the carriers have said, hey, this is a lot of liability. What if, because technically in private placement life insurance, the carrier owns the assets in exchange for a policy. Now, those assets are segregated from the carrier. But so let's take Prudential, for example. They might say, we don't want to have this responsibility of attesting to diversification, or looking over the shoulder of the manager. I mean, we're a life insurance company. We're not, an investment police force. What do we do? And so what's happened in the industry is most carriers require the use of a third-party administrator like Spearhead or Sally to actually be the manager they contract with. They, in turn, a Spearhead or Sally will use a sub-advisor agreement to contract with the client's manager. The service that Spearhead and Sally perform then is every month they're going to tell the carrier, hey, there is proper diversification and there's been no violation of investor control, which we're going to talk about.
Yep.
So now everybody feels good. The investment manager says, okay, I don't have this on my plate. And the carrier says, I don't have this on my plate. And the insurance says, I certainly don't have this on my plate. And then Spearhead and Sally, for very little basis points, provide that service.
I imagine that will grow because, it's not that you can't meet these rules, but again, the cost of making a mistake is pretty significant.
No, it's huge. It's huge.
Yeah. I mean, that's what maintains the tax-free structure. So important. All right. And then let's talk a little bit about the investor control doctrine.
Yeah. Because this is the one where I don't know how many phone calls I get a month of people saying, hey, can I do this or that with the policy? And going all the way back to 1940, so the Investment Company Act.
Investment Advisors Act.
Yeah, right, exactly. Yeah,
1940.
See, when you kind of make investment decisions around variable products, there's certain things you can and can't do inside of insurance products. And so even in your retail variable products, you may be able to pick from a platform, but those are insurance dedicated funds. So you can't actually tell the manager pre-approved,
so to speak.
And you can't tell the manager, Janus or Vanguard what to do in their private credit fund. So that takes care of itself. In PPLI, though, you really need to rely on that independent manager when you have a managed account to make all those decisions. You can't be meddling in there and telling them specifically what to buy. That's hands off here. That's where the government says, hey, now you're taking too big a role in this policy. We're going to disallow the benefits of life insurance. So you'd be in the same case you were as if you violated investor control. And you say, well, how do they know that we've done this? And it used to be a lot of times PPLI wasn't audited. It wasn't found until someone died and there was an audit on their estate. And it was usually found because the audit was about something else. And they said, oh, look, Deb's got a PPLI policy. Let's audit the emails between her and her investment manager to see if she told him or her what to do.
Interesting, because there's even a rule that you can't even communicate with it because you don't own it as the insured.
That's exactly right. The insurance company owns those assets. And so they're actually signing off on your investment manager's decisions about what's purchased. So I get questions. So obviously things like, your house, your private company stock, we won't even talk about those silly things, the boat, the artwork, and the horses, but the things that you use and enjoy, that would be investor control. So this is really for, registered, unregistered funds, LP interest in LLCs, limited interest in private equity, third-party promissory notes. Those can go in there.
Okay.
But that, again, nothing that you own or control. And I think that's.
And if we think of personal use assets as just kind of not part of this scenario at all, it makes sense.
And people even if some people say, "Oh, I only own 5% of this company. Can I put it in the policy?" And well, that depends. I mean, are you on the board? What kind of decision making abilities do you have with that company? And suddenly that changes the picture with that.
Because you have to be totally removed and you don't own the asset, and that's what maintains the structural integrity. Yeah, great.
And I tell people are like, oh, can we have an example? And we have this 2015 U.S. Tax Court decision, the Weber decision, which kind of lays out these components that we just talked about is, well, who has the ability to control decisions about money, and they get kind of specific. But I say to people, look, if you're meeting with your manager, if you give that manager a list of 50 investments and say, choose from these, that's probably a violation of investor control. If you give them a list of 500 investments and say, choose from these, that's probably not.
Interesting.
And you can meet with your manager. You meet with your manager every quarter. And if you were my manager, Deb, I'd say,
sure.
I am in in like an aggressive position. I like private credit. I don't like companies that invest in vaping. I can give some broad guidelines.
No sin stocks.
No sin stocks.
Okay.
I can even see historical after 30 days has passed, I can see the investment decisions made for my policy. But probably not before then, because I don't want to be seen as reacting to investment decisions in the short term. That could be investor control. So waiting 30 days before Spearhead or Sally shows me what my manager did for my policies is prudent.
Could be running interference though.
Yep, exactly.
Okay, it's interesting. I mean, there are some very strict guidelines here, and I think a lot of people don't realize too that the managers have to be approved by the carrier in advance. And, then the insured can't really have communication. So it doesn't come without some strings attached. And I think that's why it allows, it's allowed to be a tax-free type of investment.
And you bring up a very good point is right now we see kind of this this options strategy being promoted by some offshore carriers, where they say to a person, well, why don't you have options issued on your private company and have those options moved into a policy? There's no basis, right? If you move assets into a policy, it's a sale, you're taxed on gain. They're saying here, we've just issued these options, they're not worth anything, let's move them into a policy, so that when these options, when they spring in value, all that gain is captured in a policy. And these carriers will argue, well, you really don't have control of how options behave. So they're outside of you as an investor control, even though these are options issued on your company.
Interesting.
Or maybe a company that you have a major interest in. And so I would just remind people that one of the things that Weber tax court case talks about is you can't have a prearranged plan. I can't say, Deb, you're my manager. We're going to do X, Y, Z with my PPLI. It's not in force yet, but this is all the stuff we're going to do. And I guarantee a lot of those people that have done this option strategy, if you were to audit their emails, these people are in it with the carrier and their investment manager and their lawyer.
Looks like, sounds like, walks like. So
it is.
Again, very risky. It reminds me that also that you've had so much global experience. And one of the things you've mentioned is that there's some real benefits to even for global investors to consider U.S. policies. Can you speak to that?
No, absolutely. So it used to be, so when I kind of got into offshore life insurance, so I was an insurance company executive that managed high net worth distributions that served wealthy people through their private banks in places like Hong Kong, Dubai, Singapore, Miami to an extent. And 20 years ago, wealthy people around the world wanted very little to do with the U.S. They like to send their kids to school here. They like to vacation here, maybe buy real estate here, but they didn't want to be connected to the U.S. tax system or have any sort of planning ties. Mm-hmm. Well, what's happened over the last 20 years is sort of global tax transparency, where you sort of have two overwhelming transparency rules. So outside the U.S., the rest of the world is subject to the common reporting standard, where most companies report financial data back and forth to each other based on, they're citizens. So again,
and cross-border.
Cross-border. So a person living in Indonesia, that is from Brazil, and let's say buys, any kind of investment product, life insurance in Indonesia, Indonesia is going to report that back to Brazil, and vice versa. Well, the U.S. has FATCA. So the U.S. is not part of the common reporting standard. And what FATCA does is, because the U.S. has such power in the world, is the U.S. says to everyone else, we demand information about our citizens globally. We may not necessarily give you the extent of that same information back to you. So now if you're maybe a wealthy Chinese and you really don't want maybe your company knowing that you have all this wealth and you need a big insurance policy, maybe you want to buy a life insurance policy from I keep saying Prudential. I don't want to put them on the spot, but a major carrier in the U.S. Right? So it's not necessarily going to be reported to China that you bought this policy. Not that you've done anything wrong, but remember in China it's not that you're afraid of taxes. You might be afraid of being targeted because of your wealth.
Targeted or assets frozen or seized. That to me seems like a major chip for U.S. life insurance companies in the PPLI arrangement.
PPLI, even the retail products. You now see carriers in the U.S. offering,
even in retail. Thanks.
They're offering the ability to with their own underwriting pens to approve up to $65 million in face amount on foreign nationals. And so you probably remember 6 or 7 years ago, maybe before COVID, they might do 5 or 10 million.
Right. That's amazing that the corridor's gone that high. That's exciting.
But PPLI has always kind of had high death benefits for those folks, usually $100 million or more, for most countries.
I think you had mentioned in passing that you've been to Hong Kong. Was it Hong Kong or Singapore? 76 times.
Yeah, right. So Hong Kong 76 times, Singapore 46 times.
Only 46.
Times, right.
Okay.
Right. Okay. Well, it was on my old, kind of the sales path. Every 8 weeks, flying around the world for all those years. 18 years.
Incredible.
Well,
but you get to know the world, and that's amazing. And from an insurance window, and you were recently in China. What were you doing there? I know it was educational.
It was So I'm kind of giving back to the industry. So I'm a founding board member of an educational organization that's teaching. We're starting with Asian communities around the world, kind of teaching them advanced life insurance planning techniques. And this goes back to what I was saying, because there's this common, this tax transparency now around the world. Previously, nobody knew what you had. No country knew what you owned, but now countries do. So they're applying taxes, and there's more estate taxes around the world. And so things that we take for granted in the U.S. that we started out talking about earlier, generation skipping trusts, intergenerational split dollar, these aren't concepts known around the world. And so this organization is teaching people these kind of advanced concepts. It's a school. So we've started in China. We've recently moved to the Asian community in Canada. We'll be moving on to Australia. So I think we've already had several hundred students throughout the last few months. It's very exciting.
Yeah. That's great. What do you say? We've talked about all the key features and benefits of not just of private placement life insurance, but some of these things apply to traditional life insurance as well, joint survivor variable, for example. But what do you say to those who would say, all this tax-free compounding and all this income tax death benefit that's free, this is basically, not long for the world. What do you say to those people?
Sure. Yeah. So I kind of remind people about the spirit of the Internal Revenue Code, believe it or not. So if you kind of look at how the Internal Revenue Code treats people for their different kind of financial transactions. So for the long term, if people are long-term savers, like 401ks, it lets them, build up and have tax deferral, right? If you're in this for the long term, you're not trying to do something to get rich quick or to have income to spend immediately, you get better benefits under the Internal Revenue Code. And this has traditionally been life insurance, which is something people are typically holding until death or using. Annuities, exactly. On the other end of the spectrum, things like investments where there's capital gains right away, or even your salary, which you're going to spend, those get taxed immediately. So when I hear about a tax on life insurance, when people say, okay, well, for instance, PPLI is only for the rich people, accredited investors, qualified purchasers, we're going to attack that. And I say, well, how can you separate out PPLI from retail products? It's the same kind of Internal Revenue Code sections that dictate both. So I just remind people, life insurance is life insurance is life insurance, and the code has always treated that as a long-term savings vehicle. And as I just said, PPLI isn't something you can get in and see the benefits in a year. If you did that, you'd lose a lot of money. You need to be in this for 15, 20 years. So it's not a quick rich scheme. And I think we've talked about there's a lot of pitfalls and rules around it. It's not for everyone. So, and this can apply depending who you are to retail products, depending what you buy.
Yeah, I think that's great. And obviously, 90% of the insurance that's purchased is really purchased to replace the breadwinner's income. And that would be a widows and orphans tax of unprecedented proportion if they were to change how they treat life insurance.
Yeah. Oh, and a tax on agriculture. Think about, we still have family farms or families that own real estate. We're talking about breaking up illiquid assets in order to pay taxes. And so I hear you that just an attack on life insurance and the benefits that can apply would be detrimental to the economy.
And yes, good point. Business continuity, planning, succession, all that. So that's great. I'm going to take you back to your days at Northeastern and your leadership degree. Your degree, and you had a master's in leadership, and you've accomplished so much. I mean, is not only being a senior executive in global communities and corporations, starting your own firm. If you were to give advice to a young person about leadership, what might be a couple of tips that you would share?
Sure. So you kind of think, reflecting, and really thank you for preparing me for that question. So I wasn't necessarily put on the spot. I think back to some advice I got early on was that all you really have in your career is your reputation. You might have a job or a position or money or not, or a expense account or but it really all boils down to what people think of you and kind of maybe what they say about you when you're not in the room. So if you kind of think about people in your own career, you've met good people, bad people, and when they're not in the room, what do you say about them? And so I always advise, and by no way have I been perfect. I'm sure there's plenty of people that would, if I left the room, they'd have something to say. But I would hope for the most part that if I left the room, they'd have positive things to say. And so I tell people at a young age, how you behave and sort of how you treat other people is what's going to stick with you during your career, not the other things.
The value of reputation and being a good person, as basic as that sounds, has a lot of currency.
No, you always take time to help someone else. Take a moment out of your day to provide guidance to someone else. I think is always a kind of a supplement to that.
I think there are a lot of examples out there today where people may have money and power but forgotten about the importance of reputation and helping other people. So you're just that kind of guy, and I hope you continue to be the advisor's advisor, because you bring an educational bent to this that's really valuable. And I think today is going to inform a lot of people on so many levels about PPLI. So thanks so much for coming, Jay.
Thanks, Deb. It's an absolute pleasure to be here. I really appreciate the opportunity.
Thanks.